Alright, what's up guys? Today we're going to be talking about supply and demand. Alright, so what is supply and demand? How is it formed? How do we use it? How do we trade it? How do we make money from it? In short, supply and demand is basically like the footprints left in the sand when the big banks and the institutions, the hedge funds, are entering and exiting the market, right? So what we need to remember is that, you know, us individual retail traders, we're not moving enough money to really affect the market in a huge way, but the banks are, right? These big hedge funds and banks, big financial institutions, when they enter the market, I mean, that's when you're seeing these huge bullish runs like that, and like that, these big candles, these big moves are the banks moving the market, right? And what usually happens is, um, price will accumulate or stall, right, before a big move, right? We have consolidation, what's called consolidation, where price is not moving, it's just moving sideways. This arrow really sucks. All right, it's moving sideways, and then boom, we get a huge breakout, right? So we have what's called accumulation or consolidation, and then a breakout. And what usually happens is banks are accumulating orders because in order for them to enter or exit the market, what they need is a bunch of orders in order to fill their positions, right? So if the bank is looking to sell, what they're going to do is they're going to try to move the market in a way that accumulates buy orders. They're looking for buys from other people, retail traders, basically, so that they can fill their sell positions and move the market down. And then, of course, we lose, they make all the money. So if you're trading with the bank, then that's how you're going to be profitable in this forex market. You want to trade with the banks. So supply and demand is a way to kind of map out where the banks may be buying and selling so that you could trade with them. So how do we do it? Well, what you're going to look for is two different things. You're going to look for what's called an impulse leg, and it's basically where you have a big move like this, and then you're going to look for basing candles, right? A basing candle is basically, it's a candle that looks, usually it's where the body is small in relation to the rest of it. So I mean, like, this would be probably a basing candle. Like, you have a big candle, your impulse candle. So you have a rally base rally. That's what we like to call it. So we have a rally, price moves up, a base, right, and then another rally, right? So this would be our area of accumulation. And what we want to do is, if it's moving up, then the top of the body and the bottom of the wick is how you're going to draw this zone. So the way that you would draw this zone would look like this. Like that, right? And this is actually called a continuation pattern. So price goes up, it pauses, and continues. That's called a continuation pattern. And what you're looking for is this area is where you would be looking to place a buy order, right? So as price is moving, it's going to move up, right? And then eventually it's going to start coming down. And when price gets down to this area, you're going to buy right there. And what you can expect is for price to react to that and start moving up. Because what happens is the banks and big institutions place their buy orders here. But what happens is they don't always get their whole order filled because they're moving millions and billions of dollars. So what they do is they buy here, then they let price come back down a little bit, and then the rest of their orders get filled here, and then the market shoots up at that level. Okay. Um, and then once this area breaks a level of supply, so on the bottom we have demand. This would be called demand, and then the top zones are called supply, right? So this wouldn't be a supply because it didn't break this demand. But let's imagine that this demand was broken, let's imagine that this candle actually broke this demand. Now this demand is no longer valid, and what happens is this, let's delete this area becomes supply. So if this had a wick like that, something like that, you're going to draw your zone. It's going to look like this from the bottom, from the body to the furthest point. So on the bottom, you're going to draw from the top of the body to the bottom. On this, you can draw from the bottom of the body to the top of the wick, right? And you're going to wait for price to come back and touch this zone, because now this is a valid supply zone. So once this valid supply zone is created, now you always want to trade with the trend. So obviously, if we're in an uptrend, you don't really want to be trading off the supply zones. But I'm just doing this for an example. So if let's say we're in a downtrend, this is a supply zone. Price starts coming back up to it, hits our supply zone. We're going to enter and expect price to start moving down from there, like so. So let's take a look at this in the market. Right, and there's two major ways that I like to determine a supply and demand zone. One is obviously basing candles, and the other one is if price breaks the trend line. So for instance, let's say we're watching this market here, right? Price is going up, and then we have a trend line drawn. As you see, price broke this trend line. So where would our first supply zone be? Because now that the trend line is broken, we have candles that close past it. We have to start expecting, the structure's been broken. This lower structure, this supply zone here, this demand zone, that's right there, right, has been broken. So now price broke the trend line and it broke our demand zone. So now we have to expect price to start downtrending. So we're going to draw our supply zone. So how do we draw a supply zone? Well, first we have this engulfing pattern that broke our trend line. So how do you draw supply and demand on an engulfing pattern? Well, you have your first candle, and then you have your engulfing candle right here, right? You're going to draw your supply zone, and then let's imagine this had a wick also, right? You're going to draw from the bottom of this candle here, right? Or if the engulfing candle is small, you can draw it from, you can draw your supply zone from the bottom of here, like this, to the top of the wick, like that. You can draw it like that. But if, let's say, the engulfing candle is pretty large, then what you're going to do is you're going to draw it from the bottom of this candle, like that, to the top of the wicks, and that would be your zone, right? So everyone does a little different. It's just how I do it. So if you look on this one, because this because this candle is pretty small, I would draw my zone from the bottom of that candle to the top wick like that. That's how I would do it. For this one right here, oops, I would draw that zone like that. For this one up here, now every zone before that, every high before that basically would also be a zone. So this one I would draw from the bottom of this one, like that. And the more you do it, the better you get at it, right? This was a continuation pattern. See, we had drop, base, drop. So we have a continuation pattern right there. So we're going to draw from the bottom of this body here to the top of the wick. Now this green candle is part of our base, so we're going to draw to the top of that wick. Okay. And then price goes. And it doesn't quite touch our zone. It gets close, but it doesn't quite touch it, right? But what happens is it touches this one. So this was a zone at one point. And if you look, price came into the zone, reversed and dropped. And this was also a zone at one point, but we wouldn't have known because it didn't break a trend line yet. So price reversed. Here's a continuation pattern there, right? So let's draw this continuation pattern there. Alright, this was a continuation pattern. See, price came, went up into the zone, then dropped again. This over here. Now, why is this a zone? Because if you look left, this zone here, this demand zone here, actually this one wasn't broken yet. So this wasn't actually a full zone yet because it hadn't broken this yet. So actually it wasn't valid. But price came up, jumped off of it. Alright, so this one, this zone here, broke this zone here. As you see, it broke through it right here. So now this is a valid zone. So when you look, price came up, retested that area, and then went down. All right? This is a continuation pattern right here. We were drawing that, it broke this zone here, continuation pattern, and the price came up to our continuation pattern, dropped again. Price came up to this continuation pattern, dropped again. Price even retested that continuation pattern a little bit, but then it broke through. So because price broke through, what do we have here? We have a zone. And what happened? Price came, touched this zone, now it broke all these other zones. So now we're looking for demand zones, right? So this is demand zone here, this is demand zone here. Went up, then it broke these two zones here, and so on. So that's how supply and demand works, right? Price moves in between zones, right? So let me just draw a few examples of how you would draw certain zones. So if, let's say you had an engulfing pattern, right, and price starts moving down, you would draw your zone or an engulfing pattern there. Let's say we had a doji type deal here, or yeah, let's say doji, or small candle, and price starts moving down. Let's say we had a inverted hammer, and then some other candles. Let's say what the hell? Okay. And then price started moving down. How would you draw these individual zones? This is how I would draw them. This one would look like this. Now I would be expecting the price to come up. This one would look like this. I would draw this whole wick right here because it's such a small body. This one from the top of the wick, and then because these candles are in this area, these are part of the basing candles, I would draw to the bottom of these candles like that. Like that. So as price is moving, what I basically would be looking for is price to come back up, touch this zone somewhere, and then go back down in reverse. Same thing with this, like that, come up, hit the zone, reverse, and then this one, come up, hit the zone, and reverse. So that's basically supply and demand in a nutshell. I mean, there's a lot more you can learn, just like kind of researching and things like that, looking up supply and demand. But that's how I trade it. As you see, price does react to these levels. And of course, like I say with everything, you want to just use it as a confluence. You also want to have your trend lines in there because supply and demand is part of our fast method, right? So first is Fibonacci, then analyze the structure, which we learned about. Then we look at supply and demand. which is S, and then trend lines. Right? And then when we put that all together, that makes the fast method, which you'll learn about in part 5 of our lesson series. So we have like a trend line right here, like so, you know. So, for instance, this would have been a great entry right here, right? Because we have a trend line. We have a trend line coming down. We have a supply zone retested, right? And then maybe Fibonacci, if we measure our Fibonacci, right? 50% Fibonacci retracement, right? And we have a downtrend. So that is our fast method. That's how we would analyze that. And you'll learn more about that in part 5, like I said. You'll see a full live trade on that.